Mutual fund is an investment product that pools or collects money from various investors and then invests the collected money in various asset classes like equity, debt, gold, etc. This leads to the creation of a portfolio of assets. Now, understanding how investors make money in mutual funds. Because the money is invested in equity or debt, mutual funds may receive dividend or interest payments, which is then passed on to the investors. Another source is when the investments in the portfolio are sold at a price higher than the purchase price, the difference is known as a realized capital gain, which is again passed on to the mutual fund investors. So basically, returns on the mutual funds are generated due to any interest or dividend payments, realized capital gains, or increase in its investment values. Whereas, when there is any realized loss or valuation loss, the value of the mutual fund scheme decreases. Next is understanding how the mutual fund schemes are classified by structure. Based on the structure, mutual fund schemes are categorized into three types. First is open-ended, second is closed-ended, and the third is interval funds. Starting first with the open-ended funds. As the name suggests, these type of funds are open for the investors to purchase or sell their units anytime, even if the NFO closes. Now let's understand this NFO first. NFO stands for New Fund Offer, which means a new mutual fund scheme is launched for the first time to the investors, wherein investors are supposed to subscribe to the scheme in a limited time frame, and this time frame is known as NFO period. Now, because we are discussing about open-ended type, investors can invest or redeem their units anytime, even after the NFO period, directly from the fund house. Next point is, the units do not trade on the stock exchange and they don't have any limit as to how many number of units they can issue. In the case of open-ended funds, investors buy or sell units based on current NAV. NAV stands for net asset value. It is basically market value of all the securities held by a mutual fund portfolio, and it is calculated with the help of a formula, that is total assets minus total liabilities divided by the total number of units outstanding. Based on this per unit NAV, investors buy and sell the units. So the conclusion about open-ended fund is they are liquid, flexible and perpetual because they don't have a fixed maturity. Next category is close-ended fund. In this, units are issued during the NFO period and redeemed only on maturity. Therefore, we can say that close-ended funds have a lock-in period. Now, in order to provide an exit route to the investors before maturity, close-ended schemes are listed and can be traded on the stock exchange. Unlike open-ended scheme, this category issues only a fixed number of units. Because of the lock-in period and consistent asset base, it allows the fund manager to focus and experiment on the portfolio without fearing sudden outflows through redemptions. In the case of open-ended scheme, investors buy and sell the units only at NAV. On the other hand, since closed-ended investors have a choice to buy or sell the units from the stock exchange, the transaction price is likely to be different from the NAV. This transaction price is based on the demand and supply of the units and can be above or below the NAV. The last category is interval funds. Interval fund is a combined feature of both open-ended and close-ended fund. In this, fund house allows you to purchase or sell the units only during the predetermined period. For example, investors are allowed to buy or sell directly from the fund house twice a year between the slot 1 to 5. And the gap that is there between the slots does not allow investors to directly repurchase or redeem the units from the fund house. So we can see that interval funds become open-ended during the slots and close-ended in between the slots. Okay, so all the three types are covered. And with this, we come to an end of this video. See you with another topic. Thank you.